September has a bad reputation in the stock market. Should you just avoid investing in September altogether? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Cohorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. September and honestly October as well have a pretty bad reputation for investors in the stock market. If you look back on history, the past two big crises, just set COVID aside, were the tech bubble and the great financial crisis. Of course, the tech bubble, 2000, 2001, 2002, September was awful. Obviously, the 9/11 occurred during that time period. It was awful on the markets. And then the great the financial crisis, the waterfall selling, the waterfall declines really started middle of September. It's just awful. And so there's this stigma, there's this reputation about September and honestly October as well, that it's just an awful time period to be an investor. Is that warranted? Is it true? And should you avoid it altogether? The investment saying is sell in May and go away. That actually doesn't hold water. While May, the average rate of return in May, I'll show you here in a second, is below average, the summer months tend to be very strong. And so I would ignore that saying, but is this reputation about September and October, is that warranted? What's the data say? Guys, unfortunately, it's true. It's true. September has earned that reputation of being a rough month for stocks and for investors. Take a look at this. This is monthly average returns in the stock market, S&P 500, going back to the Great Depression. You can see there's a lot of purple or a lot of green here, where most months are they average higher. That's great. But yes, you can see here February and May about break even. The average is a little bit below below positive, so negative. But look at September. I mean, that really stands out. The average September is negative over 1%, decline of over 1% in the month of September, going back all the way to the Great Depression. And we started off the first trading day in September of 2024 was down over 2%. So we didn't start off on the right foot. So yes, guys, September sort of earned this reputation, but we also know that this isn't just any September. This year is also an election year, and logically, you would actually expect that because the election is first week in November, that the months or like the time period right before the election, so October, September, would be jittery in the markets. There's a lot at stake. There's a lot of uncertainty. So probably investors get a little skittish and there might be weakness in the markets. That would be logical. We've already addressed the question with data previously earlier this year in the Wise Money Show channel about, well, is it even safe to invest during election years? And without a doubt, the answer is yes. Data is very clear there. But take a look here. Is September, does this pattern of September being weak in the stock market, does that hold even in election years that tend to be positive and upbeat in the markets? Yes, unfortunately, it holds as well. Although surprisingly, election years in September tend to be a little bit better than the average, believe it or not. But this is data going back to 1950, so not quite as long, but still a long enough time period to draw some conclusions. And that is, September and October both on average tend to be negative in the stock market. September negative 0.4%, October negative 0.7%. Not enormous numbers to scare you away, but still showing the pattern. So guys, the reputation is warranted. It's earned. September is a bad month for stocks and can be a scary time for investors. So therefore, is the conclusion that you should avoid investing in September period. You should sell at the beginning of September and reinvest everything back in October. As a long-term investor, guys, I would argue no. Even though the data shows that, September can be rocky, there's no way to perfectly time the market. Time in the market is far more important than trying to time the market. And in fact, I would show you one other stat, one other graph that really paints a very, very clear picture of just how important it is to stay invested. Take a look at this. It can be a little bit overwhelming on the eyes, but what's overwhelming is the amount of green. Now, on the top axis, so going across, is the past 30 years of returns for that 1 year. But then going down the graph, down the axis, that shows the 1 year return, the return over 2 years, 3 years, 4 years, 5 years, and the 30-year return. So across the top, you can see that over the past 30 years, that we've only had 6 years in total that were negative. Time in the market. On average, 1 out of every 4 years is negative, and this actually shows a little bit stronger than that. And so just 6 negative years out of the past 30. But then how quickly do things rebound? And you can see, oftentimes if we do have a negative year in the stock market, the very next year we tend to recover and go on to reach all-time highs again, that the 2-year return is positive. Just clustered around those really awful events, the tech bubble and the great financial crisis, did we see it where there were a couple years in a row where the stock market had failed to come back and recoup all of the losses and get back to an all-time high. And then you have that outlier there of 10 years in 99 and 2000 where it paid to diversify. If you're just looking at the S&P 500, which is large cap US stocks, which is what this is, yeah, there was the lost decade where at the beginning of 2000 or 99, stocks went down to the tech bubble. They came back all the way back up to where they were and then declined again during the great financial crisis. Now, keep in mind, those were the 2 biggest stock market declines since the Great Depression, all within 1 decade. And so terribly challenging as an investor, and no big surprise that would lead to, well, a 10-year return wasn't positive. Being diversified, by the way, would have had a positive return for you. So guys, even though the data is clear that September tends to be rocky in the stock market, not a reason to avoid investing in September altogether. Stay the course. Here's what you should do instead. Number 1, I would argue, make sure that you're taking the right level of risk for your financial situation, for your financial goals. Right now, certainly up until September, has been a fantastic year in the stock market. The actual S&P has outperformed or exceeded the expectations of nearly all Wall Street forecasters at the beginning of the year. And so that could have tempted you to take on more and more risk, and all of a sudden you're out of balance, or you're taking more risk than what you otherwise should for your goals. And when you see a really stark, quick pullback just to start the month of September, it could tempt you into taking the barbell approach, which can be extremely dangerous as an investor, where you're all in one day, I'm full risk on, and then the very next day, I'm all out, I'm completely out, I'm risk off. And this barbell approach, or this all in, all out approach, tends to be very, very damaging on long-term returns. So stay the course with your long-term investment approach and long-term investment strategy, and make sure that strategy is taking the right level of risk for your financial situation, for your financial goals. And then second, because of the volatility that we could see, that we've tended to see this time of year, and because of where PE ratios are and the headwinds that we're facing right now, I would consider hedging or using some hedging within your equity positions. Now, work with your certified financial planner on this. There's several different ways to accomplish this to see if it's right for you and then pull it off. But work with your CFP. That is another way for you to still hopefully capture a lot of the upside and stay the course with your long-term investment strategies, but hedge and protect a little bit more in a calculated way should we see some volatility like is prevalent this time of year. So work with your certified financial planner on that and stay the course despite a challenging, potentially volatile stock market period that we're facing right now. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.